Austrian-born architect Victor Gruen is widely recognized as the father of the modern shopping center, designing the first purpose-built outside shopping mall called Northland Mall near Detroit in 1954. The post-war economic boom allied to the rapid rise in consumerism saw shopping centers become a global phenomenon. Such was the success of the Austrian-designed, American-born shopping center that it is said that while Gruen tried to make America more like his hometown of Vienna, he ended up making Vienna more like America.Read. More pensions funds are putting more money in property debt, but times have changed. Over the last decade or so, physical bricks and mortar retail in the UK has become distressed, with online shopping certainly playing its part. High street name after high street name has fallen into administration over that time as shoppers swapped the queues for shopping on their smartphones. Despite this backdrop, many funds are still overexposed to UK retail. That overexposure has consequences. Recently, M&G gated its property portfolio fund as investors fled due to fears over retail as well as Brexit uncertainty. Hammerson is now seeking to offload its out-of-town retail portfolio, while Standard Life Aberdeen is reportedly keeping a close eye on its £1.3 billion property fund, which has an over 50% allocation to retail. Following M&G's problems.Many may point at the open-ended structures and insist they have learned nothing since 2016, the last mass gating of property funds when Brexit jitters made investors panic about the liquidity of real estate. But the fact is that fund allocations take time to adjust. And retail has traditionally been a solid play that tracked consumer spending. The fund universe is a traditional one, and for many fund managers, the fact is they are rewarded by how they compare to their peers. Most long-term investors are benchmarked against the Investment Property Databank, IPD, meaning that if you match the IPD weightings you are fine. Essentially, taking a risk is not worth it. Many institutional funds still maintain a high weighting to retail. Clearly, though, the time has come for the smart fund managers to make a shift. Heavy exposure to retail is not sustainable over the short to medium term, let alone the long term, anymore. But to which real estate sectors should they ramp up their allocations? The answer is residential, particularly demographically backed and structurally supported sectors like build-to-rent, apartments and houses, PBSA, student, and the nascent later living sector. Strangely, these assets are labeled as alternative when all of them are about putting a roof over someone's head, as fundamental a real estate sector as you can imagine. In particular, UK build-to-rent has matured beyond the point where it should be labelled as an alternative. Investment is expected to hit £75 billion by 2025. For more on this story, visit the news article link.